Good morning, ladies and guests, and topics discussing different issues relating to the mandate and operations of the Bank of Zambia. My name is Luanga Mwilu. To discuss this, I have not one, but two guests. Our first guest is Ms. Phenyster Chikwashi, who is Assistant Manager, Government Securities Operations. Good morning, Phenyster, and welcome to the program.
Good morning, Dr. Luanga, and it's good to be here.
Thank you very much. We also have Mr. Finzi Mwezani, who is the Manager in charge of Government Securities. Good morning, Finzi. Welcome to the program.
Good morning. Good to be here.
So you can just search for Bank of Zambia. We'll also put a link in the comment on our Facebook page. So Finzi, to get us into this discussion, please help us understand what the Bank of Zambia's role is as fiscal agent of the government of the Republic of Zambia and how government securities fit into that picture.
Okay. Thank you so much, Wanga. So like you mentioned, the Bank of Zambia is a fiscal agent for central government. So if your fiscal policy is just about government spending, and so you have government spends according to the budget. So like any other investor or individual, you probably have budgets. So with central government, the source of revenue for government is usually tax revenue. That's the biggest. Yes, we'll have a few inflows coming in, maybe from government corporations, but the main source of revenue for government is tax.
Mm-hmm.
But because government has to steer economic activity in the economy, they need to spend. And most of the time, the spending, if you need to grow the economy, you have to spend big. But with the challenges that we have in most jurisdictions is that tax revenue is not enough to cater for that big spending. So in most cases, you have the budget deficit. So for you, if you have a budget deficit, it means that there is a component of the budget that you need to fund outside tax. So that is where borrowing comes in. So the government borrowed on the domestic side. So our mandate is to raise financing for government to fill in that gap in instances where there are deficits. So that's where we come in as agents. And because, of course, one of our mandates is also financial system stability and payment systems. We control the payment systems. So we are the bankers for government. So this role fits in well because it ensures that whatever transactions the government is having in terms of debt repayment or getting debt is handled from one single source. So we raise and we also pay out. That is mainly our role as the fiscal agent for the central government.
Thank you very much for setting that context for us. Phenyster, I'll have to bring you in here. I know that we talk a lot about government securities. We have been talking about it, but just in case there's someone who is joining us for the very first time, and to be sure that before we go further into the discussion, we have carried everybody along. Can you please just help us understand what government securities actually are?
Okay, thank you so much, Dr. Luanga. So government securities are debt instruments that are issued by the government of Zambia through Bank of Zambia as a fiscal agent, as my colleague mentioned, and these government securities are treasury bills and bonds.
Tell us more about treasury bills and bonds. What's the difference? What are they?
Okay, so treasury bills are short-dated instruments. So we have, in terms of tenure for treasury bills, we have 91 days, 182 days, 273 days, and 364 days. So the shortest for treasury bills is 91 days, and the longest tenure is 364 days. When we come to bonds, bonds are long-dated instruments. So in terms of tenure, we have 2 years, 3 years, 5 years, 7 years, 10 years, and 15 years. So the shortest for bonds is a 2-year bond, and the longest tenure is 15 years. So in terms of investors wanting to invest in a treasury bill or bond, what is just required is a 1,000 kwacha. And in terms of the auctions for treasury bills, we have them fortnightly.
Okay, that's very interesting. Because when you hear treasury bills, government bonds, they sound quite intimidating. But then now when you say 1,000 kwacha to invest, sounds actually quite friendly. So maybe you can tell us more about who is eligible to invest and how they can go about it.
Oh, okay. So in terms of who is eligible to buy a treasury bill or bonds, in simple terms, I can say anyone is eligible. So for individuals, as long as that individual has got an NRC, so that entails somebody being 18 years and above. We also have foreign investors, cooperatives, legal entities. So what is required is just having a commercial bank account in kwacha, and that account should be a receiving account. And then they have to open a CSD account. By CSD, we mean Central Securities Depository account at the Bank of Zambia. So this account does not require one to deposit any funds into it. It does not work like a commercial bank account. Yes, so that CSD account will be linked to the commercial bank account. So there are also prerequisites for somebody to open that CSD account. For individuals, they need to have a certified copy of the NRC. They need to have a tipping certificate, signatory mandate. By signatory mandate, we mean the sample signature. And then for legal entities, they need to have the certificate of incorporation and then a letter written to the Director of Financial Markets. So all these documents can just be captured and then saved somewhere. As they start the registration for the CSD, there will be a part where they will be required to load those documents. So in terms of assisting on opening CSD accounts, we do assist clients to open CSD accounts. So all in all, anyone can participate in the purchase of treasury bill or bonds as long as they have a commercial bank account in kwacha.
Okay, and it sounds convenient because you can do it online throughout. You don't need to come to the bank unless you need extra help, perhaps.
Oh, yes, we have a platform. Yes, we have an investor portal platform. As you've rightly put it, everything is now online. It's paperless. So one should just go to the Bank of Zambia website. We'll provide more details on where they can access the investor portal. It's a self-service.
Okay, thank you very much. Ladies and gentlemen, if you have just joined us, our guests today are from the Financial Markets Department of the Bank of Zambia. We have Ms. Phenyster Chikwashi, who is Assistant Manager, Government Securities Operations, and Mr. Finzi Mwezani, who is Manager, Government Securities. We are broadcasting to you live on our Facebook page as well as our YouTube channel. If you have a question or a comment, you can put it in the thread, and then when we get to that part, we will be able to read it out and respond. Coming to you, Finzi, there have been recent developments in the government securities market. So please help us understand what these developments have been, and if you can help us understand what benchmark bonds are and what liability management operations are. Yes.
Yeah, thank you very much, Wanga. And these changes obviously have raised a lot of interest and also a lot of worries. People have been calling in, writing in to find out what are these things. So I think this is a good platform for us to come in and explain, especially that there could be misconceptions that are flying around in the market. So these two, so we have the benchmark program and also liability management operations. These two go together. So I'll just try and unpack them as difficult and technical that they may be. I'll try and break it down in simple terms as we can.
We will appreciate that.
Yeah. Yeah, please, if I go too technical, just slow me down.
Okay.
Yeah. So we start with the benchmark program. What's a benchmark? So the benchmark is technically, when you talk about benchmark, it's just a reference point. So when you talk about benchmark bonds, you're talking about reference bonds. So what do we mean by reference bonds? Reference bonds are assets or securities that pricing is referenced from. For instance, you have a lot of financial transactions that happen. You have a lot of financial assets that are priced in the market. So, for instance, if you look at your loans, for instance, most loans, because they're usually short term, they're priced off maybe the MPC. You see people say MPC plus.
The monetary policy rate.
Yes, monetary policy rate plus. That's a reference. That's like a benchmark in reference. Yes. So you have other like fixed deposits. Sometimes when you go to a bank, you'll be priced say 364-day treasury bill plus some basis points or some margin, or should I say some percentage. Yes. So now on the longer end, okay, you have like mortgages. So you have other long-term transactions that happen in the market. So you need a reference point, what in financial markets will call a yield curve. This is what you use to price off. So when you have benchmarks, it's very easy to know the pricing. So for instance, you might be carrying a bond and you want to sell it. It could be between it could be a 5-year bond, but you don't know what price or what interest rate you're going to receive for it. Okay, so when you have benchmarks, it's very easy because you see where the benchmarks are trading. So with the benchmarks, and now for us to create benchmarks, we need to create what we call critical mass. We need to increase the volume on those bonds. So this is where now it's going to get a bit more interesting. Yeah, because if you look at in the past, probably we were issuing every month would issue a new instrument. By new instrument, it will be a new ISIN, completely different. Okay, but if you're gonna create benchmarks, you need to have bonds that have a huge volume. Okay, the reason being that for you to create a proper or a smooth pricing curve, you need an instrument that people are trading. You need an instrument that the market is trading frequently. Now, for you to get to that level, you need a big instrument. You need, by big instrument, I mean you need to have a lot of holders having that instrument, and it needs to have a big volume. That way, you're gonna have a lot of people who are willing to buy and sell. So it's gonna be easy for you to sell if you want to sell that bond. It will be very easy for you to go to the market and sell, because one, you know where the price is, and two, you know that because it's huge and a lot of people have it, it's faster. You'll be able to sell it quicker.
So this is in the secondary market.
That's secondary market. So in fact, one of the main reasons that we were introducing the benchmark program is to develop the secondary market. Yes, I know a lot of clients, especially on the retail side, they buy to hold. You're going to buy this bond and you're going to hold it until it matures. You just benefit from the coupons. But there's also a section of the markets, the corporate worlds, the banks, the non-residents. These buy to sell frequently. So for them to do that, you need a huge mass. So now there comes in. So how do you achieve that huge mass? It means that instead of in the past would issue these bonds on a monthly basis. Okay, for instance, in January we issue, a January bond. This January bond, it could be 5-year or 7-year. It will be paying its coupon in January, and it pays in July. Okay. Then in February, we issue another one that will be paying in February and August, March, and September. That has been the practice. But when you do that, what you're doing is you're having a lot of small bonds, okay, and it's very difficult to price because you find that sometimes an auction doesn't perform the way you'd expect or you advertise. In another month, it performs, it's oversubscribed. Okay, so you find that even though the two instruments are closely near their maturities, they have different yield rates. Why? Because the one with the bigger volume will have what we call a narrow spread. Okay, by narrow spread, I mean like the pricing is near perfect. But the one that has a small volume will have a wide spread. This is why now you see like even as an investor, if you have to sell it, you lose out because the spread is high. Why is it high? Because the person who wants to buy it is taking a risk. They might not find someone to sell it. So how do we solve that problem? We solve that problem instead of issuing a new bond. I go back to the same bond I issued. I reopen it. Okay. So the investors, those that were investing, for instance, in the April bond, okay, if they paid attention, and which I would encourage investors to do, every time there's a bond auction, you should look out for the prospectus, because the prospectus gives you the details of what bonds are on offer. Okay, so if you look at the April auction, for the April auction, I must mention that with these benchmarks, the previous benchmark program had the 3-year, the 5-year, and the 10-year as benchmarks. But with this new program, we've dropped the 3-year. So the 3-year now maintains the non-benchmark status. Then what we have as benchmarks are the 5-year, the 7, the 10, and the 15. So from 5 to 15, those are now benchmark bonds. For the 3-year, for the 2, we continue issuing the 2 and 3, but we issue them as non-benchmark. So these ones will be issuing them as every time we have an auction, we issue new ones. But for the 5, the 5 we're not issuing it this year for a specific reason that 5 years from now is 2031, and already 2031 we have a huge maturity on 2021. So we're not issuing the 5-year anymore to manage that maturity profile. So now we just so on the benchmarks now we're issuing the 7, the 10, and the 15. Yes. So the 7-year that we're issuing even this month will be the 7-year that we issued in March.
You're reopening.
We are reopening it. Then the 10-year and the 15 were issued in February. So for investors that participated in the April auction, might have realized that actually they were buying the same bond that was previously issued.
Yes.
So that is one of the ways in which we're trying to reduce the number of bonds that are in circulation. We have a lot of bonds in Zambia in circulation. Because you can imagine, Wanga, we've been issuing 6 bonds every month. So 6 by 12 is about 72 instruments. So you can imagine how many instruments we have in circulation. So we're trying. So the benchmark program tries to compress,
like just cluster and.
Yes. So that's the first part. So the first part is we reopen these instruments. So for every auction, so like for instance, like I mentioned, June, we're offering the same instruments that we offered in the April, in the April auction. So these ones will not be new. So for instance, the 7-year is the same instrument that will be paying coupon in February and August. Sorry, the 7-year will be paying in March and September. Then the 10 and 15 will pay February and August. So because we're reopening them. Then now I move to liability management operations.
We actually have an avalanche of questions,
Okay.
and I was going to come in, but I think I'll allow you to
Yes.
explain the LMOs, because we even have a question on that already.
Okay.
So I'll allow you to explain, and if there will still be information that I think needs to respond to this question, then I'll ask it.
Okay.
But you can please proceed.
Yeah. So to also aid or to beef up the benchmark program, because remember we are trying to grow these instruments to a certain level, like we mentioned in the prospectus in the circular that we released, to say that our target for each of these benchmark instruments will be 10 billion kwacha. So now to grow an instrument to 10 billion, for instance, if we advertise for the 7 year at 500 million, it means that I might have to, if I get that 500 in every auction, it means I might have to reopen this like 20 times for it to go to 10 billion. Okay. So now, how else are we going to make sure that at least we accelerate that process of growing these instruments? In comes in liability management operations. So what are liability management operations? So these are just these are operations where the issuer offers to the investors, okay, to either swap, exchange the instrument, or pay for it before its maturity. Okay, so we've got two types of liability management operations. We have the buybacks, and we also have the switches or swaps, as people may call them. So for the buyback, this is usually buyback is a liquidity operation. So for instance, if central government for some reason has so much money, cash, okay, they would want to reduce their debt by buying off, by paying off people or investors before the instruments mature. Those that are willing to sell can sell to government. By selling to government, then government reduces its debt exposure. That's on the buyback. So the buyback has the cash leg. Okay, the government pays you cash for your instruments. For the swap or the switch, as we're calling it, this is where where the issuer, in this case the government, comes in to say, look, I'm willing to exchange this bond, the bonds that you're holding, for another bond. So for instance, if you have bonds that are maturing, okay, there are certain people who don't want to get that cash. They want just to exchange into a new bond. Okay, so that's a swap or switch. So in that operation, there's no cash involved. We just calculate what is the market value of the bond that you're holding and what is the market value of the bond that is supposed to be issued. Yes. Then we get the ratio and we issue those instruments. So those are the two types of liability management operations.
Okay, thank you very much. We had questions from Angela Mwale Banda and Mektrida Malambo Milimo on the reopening of old bonds, and I believe that these have been addressed in your explanation of LMOs. But for Angela and Mektrida, if you feel like there's something that still needs to be explained, please do not hesitate to comment again, maybe. Because your questions came in before he explained, but you can just let us know if you feel that there's something that has not been covered. Finzi, you wanted to say something more?
Yes, I think on the reopening, so that's where most of the issues are coming in. When you reopen a bond, okay, it can result into three types of bonds. Okay, you can reopen into a discount bond, you can reopen into a par bond, and you can reopen into a premium bond. Okay, the first two are not a problem because I think the market has evolved and they've experienced, most of them have experienced. We used to issue discount bonds. Then we moved in 2024 to per issuance. So maybe I just explain, and then now with the reopenings and LMOs, there is a possibility of reopening into a premium bond. Okay. So now, what are the dynamics? Okay. So what makes a bond, a premium bond, a par bond, or a discount bond is the difference between the market rate. So I'm going to be technical, but I think that's the only one we will
do your best to simplify, even as you're being technical. Yes.
Yeah. So every instrument has what you call its price. Okay. What is this price? This bottle of water has a price.
Yes.
Okay. So if I bought this at 5 kwacha, but now it's at 4 kwacha. So if when a bond is issued, it's issued with a coupon rate. That coupon rate is just the percentage of how much of your face value you are going to be receiving in cash. Okay. So your coupon determines your cash flows. How much of kwacha you're going to be receiving every year is determined by the coupon rate. Okay. The time we were issuing discount bonds, that coupon rate was fixed. Okay. Now, when you're buying a bond, you buy it at the market rate, which we call the yield rate or interest rate, as you might as many people refer to it. Okay. So now, because the coupon rate is fixed, the market rate is market rate is determined by demand and supply within the market.
Yes.
So for discount bonds, the coupons were fixed, but the market rate was higher. So when the market rate is higher than the coupon rate, it creates a discount. How easy I can explain this is that a coupon is what is at determination, is like, this is what the government is ready to pay in cash. Then your real rate is what you are as the investor saying, I can lend you this money at this rate. So for instance, in a discount bond instance, the government says, look, I can pay you 14% of your face value every year. But you go and say, no, the market is at 16%. Then government agrees and says, oh yes, I'll pay you 16%. Your investment will run at 16% per year, but I can only afford to pay you 14% in cash. That 2%, I'll be borrowing it every time I'm not paying you. So that is what accumulates to your discount at maturity.
At maturity.
Yes.
Okay.
With a par bond, the government is saying, I'll match whatever interest you are telling me. So if you're telling me 16%, I'll also pay you 16% in cash, so that I don't owe you anything at
maturity,
at the end. Yes. With a par bond, you are saying, government is saying, look, I'll pay you 14%, but your market is at 12%, for instance. So I'll pay you more cash, in cash, than we've agreed that your investment should run. Because I'm going to pay you more cash, it means that instead of you paying me 100,000 for a face value of 100,000, you have to pay me more to compensate for that extra cash that I'll be paying you in coupons. So that's why the premium comes in. So if you look at the auction in April, the coupon rates on the 7, 10, and 15 were higher than what the market settled at. So government was saying, I'll be paying you a higher cash. But for this higher cash, because your market has settled here, you still need to compensate me for this extra cash that I'll pay you in coupons. That's why if those that participated in the April auction will realize that you paid more cash than your face value. It's because you're paying back government for the cash that they're going to pay you, the extra cash that they're going to pay you on your investments. So I just thought I would highlight that par, discount, and premium concept.
Okay, very helpful indeed. So I think before we move on, what then does that mean for current holdings? Like with everything that, like the changes that you have mentioned. What will happen to current holdings?
So for current holdings, nothing changes.
Okay.
Nothing changes. So for the reopening, for the liability management operations, the LMOs,
Oh.
these are voluntary.
Okay.
Yes, you're not going to force anyone. These are voluntary. If you want to exchange,
Then you can
exchange.
If you don't, you continue to maturity. Okay. Thank you very much. Ladies and gentlemen, well, today our topic is adjustments in the government securities market. I know that government securities as a topic is always of great interest, and I am seeing some questions. So if you are new to the topic, please do not feel discouraged that you're not understanding everything. This is just that we are explaining specific developments in the government securities market. But if you joined late, you can still watch a recording. At the end of this program, you can watch a recording on our Facebook page as well as our YouTube channel, and you can also learn even the basics of government securities, because that is where we started. So Phenyster, I'm going to bring you in. In his explanation, Finzi made reference to benchmark bonds, non-benchmark bonds. What then is going to happen, like in terms of tax and interest? Will there be a difference between these two going forward?
Oh, okay. Thank you so much. So in terms of tax, I believe you're referring to the tax on interest.
Yes.
Oh, yes. So in terms of tax, it remains the same. So 20% with holding tax will apply, and 1% handling fee. So in total, that's 21%. The other aspect of interest, I think Finzi touched on that. So actually, what if you would allow me,
Yes,
what will happen in terms of interest is just what he explained. The coupon payments for the reopenings were decided in the first issuance. He referred to the February and March auctions. They were determined in that first issuance. And then if they are reopened, that would mean that in that particular reopened auction, what will be decided by investors will be the yield rate. So the cutoff yield rate is the rate that everyone is going to pay at. So depending on the yield rate compared to the coupon rate, that instrument will be offered at a premium or at a discount. And then the other aspect is on those investors. Sometimes we receive calls to say, how do I top up on my holdings? I'm actually looking for this instrument. This is an opportunity for those that want to top up on the same instrument. For example, Dr. Luanga, if you bought a 7-year bond in March and you are looking to top up on that bond, an opportunity came in April for you to buy more and receive the same coupon payment that was determined in the March auction. Also, for those that missed the February or the March auction, it's an opportunity that they can take advantage of and chase after that coupon payment, because it was already determined in that auction. It's not going to change. What will change is the yield rate, as Finzi alluded to.
Okay, thank you very much. As I mentioned earlier, we have a lot of questions, and I have noticed as we are discussing, some of the questions are already being answered. So I'm going to skip those, but we'll still get back to them in the comments if they feel that they still want an explanation. And then I've seen a question here, and I just want to give this general guidance that if you need something that is specific to you as an investor, we encourage that you get in touch with the bank and then have a one-on-one sort of resolution. We allow the program to be as informative as possible to a wider audience, rather than just addressing one issue. So I'm going to read some questions. the ones that I think have not been overtaken by the responses, explanations already. We have some questions from Memory B. Simwava. And the first question is, how can an ordinary Zambian, not a finance person, easily determine the price of premium bonds before bidding to ensure they have enough funds? The second question is, what practical steps can the public take to sell a bond if their bank cannot buy it? And then the third one, will bonds be issued every other month? You can let me know if you need me to repeat any of these questions, or if you're good to respond. I think we can start with those.
Okay. I hope I've taken down some questions. I think you can just remind me if I miss something, and then Finzi would come in. So in terms of buying or selling a bond, commercial banks act as agents on behalf of their clients, because depositors are their clients. So if one wants to sell or buy a bond, they can visit a commercial bank and just inform them of their intention. So the commercial bank will assist a client to look for the buyer or the seller of that security. If the bank says we are not able to, they can visit another commercial bank, probably where they're not banking, to just inform them of what they are trying to do. Once that commercial bank accepts, then they can move that security to that particular commercial bank, who assist or facilitate the sale or purchase of that instrument.
Yeah, maybe just to add in, so when you're buying and selling a bond after issuance, okay, so if you hold a bond, for instance, if you're gonna sell it, that's in the secondary market. So in the secondary market, we have what we call brokers. Okay, so we are alive to the fact that most individual investors are not exposed to brokers. So the easiest broker and good that we would have at the banks. Those are the first point of contact. It's easy, but the market has. If you go to the Securities and Exchange Commission, if you go to the Lusaka Securities Exchange, they have a list or a group of brokers that can also assist in selling. But if you take the route of going to your bank, and your bank is not willing to buy that bond, you can go. There are a lot of active banks around that facilitate that process, and it's a very easy process, because all you have to do is, when you go to another bank, you're going to present what you present what instrument you're holding. So every bond has a number. So you're going to present that, which is called the ISIN. Okay, every bond has an ISIN, like a serial number. That is what you're going to present. And you're going to present to them to say, this is what I am selling. How much can you buy? If you agree on the pricing for that bond, they're going to assist you. What you have to do is, you have to write to your bank, your current bank, the bank that didn't want to buy, to move that bond to the other bank.
Okay.
Yes. And once that is done, then the other bank can transfer your money into your bank account. Okay. And I also must mention here that one of the good things about these government securities is that you don't have to sell the whole lot. Okay. So, for instance, if I have a commitment, say I have 5,000 in a bond, okay, but then I need to pay, I don't know, maybe something, DSTV or whatever, for 1,500. Okay, I can sell a portion of it to get that 1,500. I do not have to sell the whole Yes, because they're dematerialized. So you can cut them into different ratios.
Okay.
So yeah, so that is so for those ones that have finding, and it's a very I think even as regulators between the central bank and the Securities Exchange, I think we are working towards finding a better way of handling the secondary market in how people are disposing of these instruments. So, but currently, like Phenyster said, obviously the easiest point would be you go to your bank and your bank facilitates. But those that are exposed to the brokers, they can also go to the brokers, the Securities Exchange, and do that trade from there.
Okay.
Maybe in addition on what Finzi has stated, you find that these securities are very, very liquid. Takes us to the point of liquid assets. Government securities are liquid assets. You can easily buy and sell in the market and easily have access to that cash. As he has stated, you are not required to sell everything because you want to sell. So you can just sell that portion. And then later on, if you wish to buy back the same instrument, yes, you can still look for it in the market and put it back. So these instruments, an advantage is that they are very liquid.
So the final question was, will bonds be issued? The final question from memory, BC Moaba, was, will bonds be issued every other month? And I think that the way that you can take this, because I've also seen other questions asking about the calendar. So maybe you can just explain how the calendar is issued, where people can access it to respond to everybody collectively.
Okay. So in terms of the calendar, calendars are issued on a quarterly basis in consultation with the Ministry of Finance. So for this quarter, like for reopenings, the calendar states that there were going to be 2 auctions for bonds. That was April, and we'll have another one, which is the second one of the quarter, on the 26th. So 2 bonds in this quarter. For the next quarter, the calendar will be issued to the public by end of June.
Okay.
I think maybe just to also write on that. So like for Q2, quarter 2, we were issuing. We're going to have 2 auctions. The first one that we had in April, and the one that Phenyster just mentioned on the 26th. You might remember that in the first quarter we had 3 auctions: January, February, and March. And for bonds, they were at 4.2 billion for each auction. But because in the second quarter we're issuing twice, it means that that's 4.2 by 3, which comes to 12.6. So it means that in January, February, and March, our auction size for the whole quarter on bonds alone was about 12.6 billion. And then for the second quarter, because we're issuing twice, 12.6 billion divided by 2 is giving us 6.3. So that's why if you look at April, the auction size increased to 6.3, and for June also it will be 6.3. So in total, for the second quarter, we're looking to issue 12.6. I mentioned this because a lot of questions are coming in to say, with all these developments, with all these benchmarks that you are introducing, with these elements, does this mean that government is issuing more debt? Okay. No, government is not issuing more debt. The government, for government to issue more debt, government, it's because when the minister presents his budget, he informs Parliament on how much he needs to borrow from you. So the moment that budget is approved, it becomes law. You cannot alter it. So the amount of debt or amount of money we're going to raise in 2026 was determined already. Okay, so it's just the frequency, because the frequency changed. from 3 times in a quarter to 2 times for Q2. That's why the auction sizes for Q2 increased. That's not to say that government has started to borrow more. No, we're still within the mandate of borrowing what was approved in 2025 for 2026 spending.
And in addition, these issuances that we did in Q2, it was also to give room to secondary market trading. I think in the month of May, there wasn't any issuance of bonds. So it was creating room for secondary market trading, investors getting into the secondary market, and encourage that trading in that market.
Okay, thanks very much.
Maybe just because I think Memory's first question was on how do you determine
On pricing?
Yes.
the premium bonds? Yeah. So the way auctions are run, right now you have the competitive and the non-competitive. Okay. So for the competitive, it's easy. Okay. I must say we are trying to look. We're trying to put a calculator either on the website or on the investor portal, just to guide investors, so that when they put in an interest rate, they see the what cash consideration they need to. But I would advise for maybe I start with explaining between the competitive and non-competitive. So for the competitive auction, you are competing. Okay, you and I are competing.
Yes.
So you put an interest rate that you feel is favorable for you and you'll be accepted. She puts an interest rate that she feels would be accepted, and she'll get something. Like any other borrower, government borrows at the lowest cost. Okay, and this also answers a question that a lot of people ask, to say Bank of Zambia is reducing the rates. No, we don't reduce the rates. The rates are being reduced by the investors themselves.
I actually have some of those questions.
Yes, the investors are the ones that reduce that interest rate. It's not the central bank. Okay, so what happens in a competitive auction is that when everyone bids, your bids are lined up starting with the lowest yield or the cheapest. So for instance, if I'm looking for, hypothetically, I say I'm looking for 100 million kwacha on one instrument. You come in with 50 million. No, it's just an example. You come in with 50 million, okay, at say 13%. I'll get that 50 million. I'll remain with 50 million. She comes in with 20 million, maybe at 13.5. We'll get that 20 million, then we'll remain with the 30. So you go on like this until when we get to the last point, say for instance, I'm remaining with 10 million, but a bank comes in with 30 million at 15%. I'll only get 10 million if that's what I need to get. 10 million, and I will reject the other 20. So I only give them 10 million at 15%. So everyone that bids below that 15% will be awarded 15%. Why? Because in Zambia, unlike other markets, in Zambia, we use single pricing. Okay, we allocate at one price. So everyone is elevated. Everyone that bid below that level is elevated to that high level. So there are also bids that were placed above that cutoff yield. Those ones are rejected because they're deemed expensive.
Okay.
So when that market price is determined, the cutoff, what we call the cutoff yield, that is the same one that is now being allocated to the non-competitive. The non-competitive do not compete. These are what we call price takers. Okay, so they come in the auction. This is currently it's between 1,000 and 499,999 kwacha. That's a non-competitive window. So there you are a price taker. Whatever is determined in the competitive is what is allocated. So if you are playing in the non-competitive window, it is very difficult for you to know what price will be allocated. because you depend on the competition on the other side. Now, the competition on the other side, because you've put in an interest rate that you want to bid, you will know exactly what, if it's a, I'm thinking this bond will be premium, what would be the premium amount you can pay?
Fortunately, running out of time, we will be concluding soon, and I just want to reassure our audience, if you've put questions in the comments and we're not able to take them on this live program because of time constraints, we will get back to you and respond on the same thread where you have written your question. So Phenyster and Finzi, in a minute or less, I'll just ask 2 questions from the audience and a final one from myself. So if you can just allocate maybe a minute to each of those 3. So the first question is from Mary Goodson. What causes certain bids to be rejected despite being placed at the same interest rate accepted by the Bank of Zambia? Probably like, okay. And then this, I'll read I'll read Katema Piri's question, but this has also been asked by other people. The question is, so for those that participated in April and bought February 2026 bonds, what will happen in August when we are due for coupons? Will we get the same coupon as the ones that got in February? Or will there be will the calculation be prorated? So the question really is, how does the reopening affect the coupon payments? If you were in the initial or you've come on a subsequent auction, how does it affect the coupon rate? Then my final question is, what is the bank doing to ensure that the market and retail customers are aware of these new developments in the government securities market? So if we can,
okay, I can start. I'll look at the first one. What causes a bid to be rejected, even when the rate that was indicated in the bid was at the accepted rate? This does not happen. Probably this could have been that the bid was not approved. What I mean is that when one places a bid, that bid goes to the commercial bank. The commercial bank has to confirm if funds in the account of that particular investor, if the funds are sufficient to cover the bid that they've placed. Sometimes it happens that the cutoff for the auction approval has been reached. It means that that bid remains hanging. It does not enter the auction system itself. That's when that would happen. And we've seen a number of cases on this, though they have drastically reduced. It has never happened that the bid was in the auction when at the point the auction was closing and finalized, and the cutoff yield was not, that particular bid was not awarded the same cutoff yield. On the other one, in terms of what will happen to the coupon payment, for those that bought, for example, if I participated in the February auction, I bought 50,000 worth of securities. I again bought the same instrument, 50,000. That makes 100,000. So when we come to the coupon payment date, the one who purchased 100,000 in February, and I who got 50 in February, and then in April another 50. In total, we have 100 each.
Yes.
We are going to get the same coupon payment that particular time.
Okay.
And then on the third one, in terms of what the bank is doing, we've been holding sensitizations. We've been doing this for quite some years. We do have sensitizations here in Lusaka, as well as the Bank of Zambian dollar. So for dollar, we have sensitizations on Mondays, and then Wednesdays in dollar. Those days have been put aside for just on a Wednesday, that's in dollar. to help clients open CST accounts and those that have come in maybe to place bids, as well as those that have issues related to their holdings. So for Bank of Zambia Lusaka, we have sensitizations on Tuesdays, and then Thursdays, we assist clients open accounts, attend to issues relating to their CST accounts, or maybe placing bids. We also have tailored sensitizations through requests. We also have road shows. We also attend shows, and I would urge would-be investors or the public to visit the Bank of Zambia stand at the trade fair, as well as the agriculture commercial show that will be held here in Lusaka. And we also attend various provincial shows just to give information, to sensitize, as well as assist clients. Also, we have dedicated numbers that we are going to share. Clients can call in or request a call back and attend to their issue. We also have the dedicated email address where they can...
you can tell us the email address.
Okay, the email address is governmentinfo.securities, also info at boz.zm. We also have a chatbot, Tandizo. I think I'll give out this number. This is on WhatsApp. The number is 0762 75 8347. This is a chatbot, WhatsApp 076 275 8347. And then the dedicated cell phone numbers. Maybe I'll start with the landlines. We have Ndola 399 600. 399 600. This is a landline dollar. Lusaka 399 399. Lusaka 399 399. And then we have the switchboard line, which is 399 300. 399 300. And then in terms of the cell numbers, we have 0979 077 998. 079 077 998. Don't know if you can add more numbers.
Well, I think we'll give you the what's this the numbers, because I think maybe we need to type.
Okay.
Yeah.
Okay.
And then just to emphasize on the bid cutting off, please, when you're placing a bid, make sure your account is fully funded, and also make sure that you do not have outstanding standing orders on the accounts, because you might place a bid and you have a standing order, say for instance a loan repayment,
and then it goes through.
Then it goes through. By the time your bank is seeing it, they say insufficient funds, because a bid that is placed at the cutoff rate or lower than the cutoff rate cannot be rejected. So the only way it's rejected is either it was the account wasn't fully funded, or in rare instances your bank did not attend to it. And then on the landlines, I know one of the biggest complaints we have is that the lines the phone calls do not get picked up. Yes, it's a very genuine concern, and the reason for that is that as a team, those phone calls go around. So now the fact that it's a very busy desk, you find that sometimes you're on the phone with another client that came through that line. So if it comes through when I'm on the phone, it will you will not get the message that
that it's engaged.
It's engaged. So it will go to the next person. If the next person is also busy, then it goes round like that. So that's why those are the reasons why most of the times clients will say Bank of Zambia do not pick up phone. We do pick up phone calls, but like you mentioned, from the email address that has been provided. If
That's
you feel,
another option.
yes,
Mhm.
if you feel that you need someone to talk to, you can write.
Mhm.
You can write through the government securities email, and we've seen a lot of emails come through from
Info.
your end, yes,
Mhm.
from the info, or you can call through the general line and ask for a specific, if you have a specific contact in the government securities unit, you can ask for, and they need to be transferred.
Okay. I wish we could continue talking, but as both Phenyster and Finzi have shared, the bank remains reachable even beyond this program. So you can contact the bank through the different platforms that have been shared here. You can send an email, you can chat on our chat board, you can come to our website. There is information, and there's also always someone available to take you through. In Ndola, as Phenyster had mentioned, Monday and Wednesday; in Lusaka, Tuesday and Thursday. If your question was not answered due to time constraints, or maybe it had already been covered in the explanations, please just watch the recording. It's available on our Bank of Zambia Facebook page, as well as our YouTube channel, which you can just search. It's Bank of Zambia. And if it was an individual question that we feel requires a one-on-one engagement, we will still get back to you with that. So Phenyster and Finzi, thank you very much for this insightful discussion. Have a good day.
Thank you
It was
so
a
much.
pleasure.
It was a pleasure having us.
And thank you very much, everybody. Do have a good day as well.